Value ETFs typically serve as the defensive play in a balanced portfolio. They are generally less volatile, have limited growth upside, but often offer higher dividend yields than S&P 500 index funds. They also provide good diversification compared to technology concentrated ETFs such as QQQM and even VOO, as mega-cap tech companies continue growing disproportionately larger than the rest of the S&P 500. In today's video, I will share one ETF that has surprisingly been outperforming VOO this year after accounting for dividends, and how I allocated and other value stocks in my portfolio. This channel is all about investing and personal finance to help you retire early. You can also join my Patreon community for guidance that can help you become a more confident and successful investor. The value ETF I'm introducing is XLU, the Utilities Select Sector SPDR ETF, issued by State Street. The fund tracks the S&P's Utilities Select Sector Index. This index includes companies across various industries: electric, water, gas, and multi-utilities, as well as independent power and renewable electricity producers. All of these companies are part of the S&P 500, making them some of the best companies in the US. As you may know, companies must satisfy a number of strict qualifications to be included in the S&P 500, including profitability, market cap, and liquidity. XLU follows a quarterly rebalancing schedule in the same months as the S&P 500: March, June, September, and December. It adds and removes companies based on the S&P 500 selection process, but only within the utility sector. The weights of individual companies are also adjusted so that no single company exceeds 23% of the index, and the total weight of all companies that individually higher than 4.8% is capped at 50%. These constraints help satisfy diversification requirements under IRS rules. The ETF is passively managed and has an annual expense ratio of 0.08%, higher than VOO's 0.03%, but it offers a 2.61% dividend yield, more than double VOO's 1.09%. The largest company in the index by market cap is NextEra Energy, which generates and distributes electric power from clean sources, such as nuclear, solar, and wind. It is followed by Constellation Energy, another national clean energy producer with the largest nuclear fleet in the US. There are a total of 34 holdings in XLU. Needless to say, all of them fall within the utility sector. A majority, over 65%, operate in the electric industry, which I'll explain later as an important driver for the fund's performance. About 99% of the holdings are large and mid-cap companies. Since its inception at the end of 1998, XLU has delivered a total return of 7.93%, slightly behind the S&P 500's 8.79%. Its volatility measured by beta is 0.62, about 38% below the benchmark. This can be clearly seen in the year-to-date chart. From the index peak in late February to the tariff-induced crash in April, XLU dropped from a high of $80.53 to an intraday low of $71.02 on April 9th. That was an 11.8% decline, while VOO by comparison fell 21.5% over the same period. Year-to-date, as of end of November, XLU delivered a total return of 22.25%, including dividends, outperforming VOO's 17.77% and also beating the popular value index fund VTV's return of 14.37%. So how could a boring utility ETF like XLU deliver such strong returns in 2025 and possibly continue to do so in the future? The secret lies in the powerful secular tailwind driven by the AI boom. With massive investments in computing capacity needed to support AI training and inferencing, Hyperscalers' data center expansions have accelerated in recent years. And what powers data centers? Electricity. According to an article from the US Congress website, domestic data centers consumed approximately 176 terawatt hours of electricity in 2023, about 4.4% of the nation's total usage. Some projections show that this demand could double or even triple by 2028, reaching 325 to 580 terawatt hours, or roughly 12% of total consumption. Modern AI data center capacity is now measured in gigawatts. A data center with a continuous power demand of 1 gigawatt will consume approximately 7.4 terawatt hours of electricity per year, assuming it operates at around 85% capacity. Recent deal-making announcements suggest that OpenAI alone could require 30 gigawatts of data center capacity by year 2033. That translates into an annual electricity requirement of about 222 terawatt hours. One AI company's power needs over the next 8 years could exceed total US data center consumption from 2023 by 26%. If you include the AI infrastructure investments from Microsoft, Google, Amazon, Meta, and Anthropic to power their own AI models, it's not hard to see how electricity demand could double or triple by 2028. The top two companies in XLU, NextEra Energy and Constellation Energy, reported year-over-year adjusted EPS growth of 9.7% and 10.9% in Q3, respectively. With robust AI data center demand over the next 3 to 5 years and strong government support for nuclear power plants, EPS growth rates near 10% are likely to be sustained. Combined with roughly a 2.5% dividend yield, XLU could offer an attractive 10 to 15% annual total return going forward, and even has a chance to outperform the S&P 500 again. From a risk perspective, if we ever experience an AI bubble burst, the data center segment of these businesses could suffer. However, as noted earlier, data centers are expected to make up around 12% of total US electricity consumption. That still provides a meaningful margin of safety and solid business diversification for utility companies. Additionally, the utility sector in general offers a recession-proof investment opportunity. Now, how do I plan to allocate XLU in my stock portfolio? Currently, I own XLU, the healthcare giant Johnson & Johnson, and value-focused retailers Walmart, TJX, and Costco. These stocks serve as the defensive holdings in my portfolio, representing roughly 20% of the allocation, including 5% cash. The remaining 80% is invested in growth names, including the mega-cap tech companies. Recently, I ran my custom stock screening program to calculate momentum scores across S&P 500 companies. The goal was to identify potential market trend shifts by analyzing changes in sector allocations. For more details on how the program works, please watch this video. I shared my latest findings on market sector rotations and future allocation strategies with my Patreon investing group. This helps members adjust their approach and better protect their portfolios. I invite you to join them as well, so you don't miss my monthly market sector updates and many other benefits. I'm currently offering a 1-month free membership for the holiday season, so take advantage of this promotion while it lasts. Using a more sensitive 3-month return window for the momentum score, I noticed that within the top 100 stocks, the healthcare sector weight increased from 10.6% in October to 19.8% in November. This raised the overall defensive sector allocation, consisting of healthcare, consumer staples, utilities, and energy, to 24.7%. This could indicate an early signs of weakness in the growth sectors. That said, this shift may still be a short-term swing in market sentiment and may not change the broader long-term AI-driven growth trend. However, to stay vigilant, I become slightly more cautious heading into 2026. As a result, I plan to increase my portfolio allocation to XLU, J&J, and my retail holdings over the coming weeks to 25 to 30% so that I'm better positioned should the market continue rotating away from growth sectors.